usually the idea is Sunday, we'll be doing market reviews and we'll be attaching it with a bit of some lessons, to those who already know the basics and everything. To those who don't know the basics and how to go about it or how to even place a trade, I will be constantly releasing those videos that I post so that you catch up with everyone. Okay, so before we do our market review, I just want to talk about something which is very, very important that you need to be considering when you take a trade. Okay, so I've started revealing now the secrets, the things I do that makes me more profitable, and that makes me avoid the certain trades. When I just look at it, I just avoid it. I know this is not a good setup. Okay, so briefly, I'm going to talk about the market trend. Okay, so let me just define what the trend is. So trend is a market moving predominantly in one direction. Okay, so this is just a trend. Any market that is predominantly moving in one direction, we'll call that market as a trending market. Okay, so you will find that in Forex, move up or the market can move down. Okay, so the downward or the upward movement of a market, we call that trend as a bullish trend. So when the market is consistently, okay, so this is the keyword here. When the market is consistently moving in an upward direction, we'll call that a bullish trend. Okay, so when a market is moving in a downward direction, like it is consistent also, we'll also call that as a bearish trend. We'll call it a bearish trend. Okay, so that consistency needs to happen over time. Okay, so the time here, it differs. There are some markets which will trend just for 1, 2 days or 3 days, but there are some markets which will trend the entire month. They are just moving in the same direction. Okay, so what do you have to know about how do you now take advantage of this? Okay, I'm sure those who have researched about Forex and everything, you have come across this saying here, which says a trend is always your friend. A trend is always your friend. Okay, so what this means is just that when you identify that the market is going up, when you identify that the market is trending upwards, you have to be in line with the trend. So all your trades are going to be in line with the direction of the overall market. Okay, so now if you don't know the real trend, a trend can hammer you very bad. You can think as if the market is in an upward trend, not knowing that is just a pullback. The market is in a downward trend. Okay, so instead of a trend is always your friend, a trend can be your friend if you understand it. A trend can be your friend. Okay, so every person who knows how to trade, before they even press a trade, they need to identify the market condition. Am I in a bullish trend, a bearish trend, or there is another one which is called a ranging market, whereby the market is not trending in any direction. It is just moving up, down, up, down, up, down like that. Okay, so that you avoid the false signals and the losses. Okay, so a bullish trend So how does a bullish trend move? So you find that in a bullish trend, this is how price is going to behave. So we are going to have something like this. I hope you can see what I've drawn there. Okay. So you're going to have higher highs and the higher lows. Okay. So we are going to start with the higher highs. What does this mean? A bullish trend will give you higher highs. So what does it mean? So if you look at what I've drawn here, remember in Forex, market does not move in a straight line. You will never find market that will just shoot upward. Like it will always make pullbacks and to confuse a lot of people. No wonder a lot of people lose a lot of money if they don't understand how price is moving. Okay, so if you see the way a trend in an upward direction is that every new high the market is going to be forming, it is going to be higher than the previous high. Okay, so here, this is the previous high the market made, and it moved and made another high which is higher. It moved and made another high which is higher. It moved and made another high which is higher, like that. So you can see that this market is trending upwards. Okay, and it will also have higher lows. Okay, so every low that is going to be made is going to be higher than the previous low. Okay, so this is the previous low here. The new one is higher than the previous low. The new one again there is higher than the previous one. The new one is higher than the previous one. The new one again is higher than the previous one. Okay, so now whenever this pattern is broken of forming higher highs, just know that the market is trying to reverse. Whenever the pattern is broken, just know that the market is trying to reverse, is preparing for a reversal. Okay, so looking at this example, the chart example here, you can see this is Euro USD. This market made a low here on your left. Okay, it moved and made a low here. So this low is higher than the first low. So this is a higher low. It moved again and made a higher high there. It moved down, a higher low. It moved up like that, a higher high. Sorry, a higher high. It went down, a higher low. It went up like that, a higher high. It went down, a higher low. It went up, a higher high, a higher low, a higher high, a higher low, a higher high. Then from here, it made this low is not higher than this. So there is a break in market structure. What do you expect there? If there is a break in market structure, you can see the low here is not, the low which is formed here is not higher than the previous low, meaning this market is preparing for a reversal downward like that. Okay, this is a 4-hour time frame. For you to know the correct trend of the market, you need to go to higher time frames. Remember the higher time frames, you have the 4-hour, daily, monthly, and all that. So depending on the type of a trader you are, you use either 4-hour, 1 hour, or not 1 hour, 4-hour, daily, or monthly time frame. Okay, so the time frame that we are using here is a 4-hour time frame. Okay, so we move on. A bearish trend. Remember what we are doing here, we are just identifying a trend, and after identifying a trend, we'll go now to the time frame that we use to trade. We go to the time frame that we use to trade. Okay, so how does a bearish trend behave? Okay, so in a bearish market, you are going to have this kind of pattern. Okay, so again, price will be dropping and it will be doing like this. Okay, then that. Okay, so you can see here in a bearish trend, it's the opposite. You start having lower highs and lower lows. Okay, so if you look at this high here and this high, the new high which is formed is lower than the previous high. The new one which is formed again will be lower than the previous high. The new one which is formed will be lower than the previous high. The new one which is formed lower than the previous high. The same with the lows. Okay, this low and this one, the new one which is formed is lower than the previous one, just like that. Lower low, lower low, here you have lower low. So now when the market starts failing to make the lower lows here, instead of making this low down here, it failed and made it up here. So just know that the market is preparing for a reversal. No wonder when you are at a peak, you have head and shoulder pattern. You have head and shoulder pattern. So you have a pattern like this, shoulder, shoulder, head. It's because the market is failing to go down like that. Okay, let's look at the chart examples. So now this is a daily time frame that I've put here now to show you that it happens in all the time frame, these trends. Remember, the time is what differs. Some trends can go up to 1 month. Some trends can go up to 2 months. Some even years, they are just trending. Okay. So if you look at this chart that I've put here, you can see the high is there. Market dropped and made a lower high. It dropped, put back and made a lower high, dropped again and made a lower high like that, dropped, made a lower high, dropped, but this drop did not take out the previous low here, meaning the market is preparing to reverse at that point. And eventually the market started making higher highs, higher high, higher high, higher high, higher high, higher high, higher high. Failed to make a higher high, so it will reverse again like that. So in this picture, you can see there is a downtrend and an uptrend. Okay, so this is an uptrend there. That is a downtrend like that. When they are failing to break the structure that they are formed, means the market is trying to reverse. Okay, so the importance of knowing this is that it will keep you away from a lot of false signals. Remember, when you go in higher time frames, big banks and the central banks, they don't use 15 minutes, 1 minute to trade. They use the daily, 4-hour, monthly time frame for them to put their orders and execute. No wonder if you go, the higher you go in time frame, the more accurate you'll be, but the less you are going to be trading. The less you are going to be trading. So you see what the big guys are doing on higher time frames and come to the trading time frame that you are trading with and execute the market. So moving on, so we have seen that there is you can identify a trend just by looking at it. If you can see higher highs and lower lows, okay. But there is a simpler way of identifying a trend. There is a simpler way of you just wait and see, and everything will line up. Okay. So this simpler way of identifying a trend is by using 13 and 50 exponential moving averages. So these are exponential moving averages. Those who don't know what a moving average and what EMA is, I'll be explaining when I start doing those introductory videos. All these will be explained in those introductory videos. Okay, but they are basically just lines on the chart. Okay, so the first thing that you need to do before you even identify what you want to see, before you identify what you want to see, is you define your trading time frame. Okay, so again, those who like don't have an idea about the trading and the anything, we'll talk about the types of traders that we have. So we have the day traders, like the intraday traders who trade every day. We have the swing traders who take one trade can last maybe up to 3 days. Then we have the position size traders who take, if they take a trade today, maybe they will leave after 2 months or 3 months, like that. Okay, so I'm going to be focusing on day trading. So day trading, the time frame that you are going to be utilizing is a 15 minutes time frame. The 15 minutes time frame is the time frame you're going to be utilizing as a day trader. Okay, so now as a day trader, you are not going to go to a daily time frame to identify your trend. Instead, you're going to go to the 4-hour time frame. You're going to go to the 4-hour time frame for you to identify your trend. Okay, so you identify first, you define what kind of a trader do you want to be. Are you going to be a swing trader or what? So I'll talk about day trading. So if you have identified, okay, I'm going to do day trading. Okay, so what next? What follows next? So if the 13 EMA is above the 50 EMA, then that is a bullish trend. So this is very simple and straightforward. Again, if the 13 EMA is below the 50 EMA, that is a bearish trend. Okay, that is a bearish trend. If you don't know how to identify the higher highs, higher lows, all that, just follow this and you'll be fine. You'll be fine. Okay, so again, if the 50 EMA is flat and the 1350 crossing constantly, then that is a ranging market. The market has no direction. It is just ranging. It is just moving up, down, like that. So you have to know how to avoid the fourth market, because this market, it will chop you. It has no direction. You think the market is moving up, then it will reverse, moving down to reverse, like that. Okay, so if you look at this chart, the blue line which is passing on the chart there, that is my 50 EMA. That is my 50 EMA. Okay, then the red line there, that is my 13 EMA. So the 13 EMA is a fast moving average because it responds to price fast. The 50 EMA is a slow moving average because it is responding to price slowly. Okay, all these they have value, as you have said. So this is my 800 EMA and this is my 200 EMA. Okay, so looking at the EMA, we just want to identify the trend. Remember, before we do anything, first we need to identify the trend. Where is this market dominantly going? Okay, if the blue line is above the red line, then that is a downtrend. Just like this point said, If the 13 EMA is above the 50 EMA, that is a what? A bullish. If the 13 EMA is below the 50 EMA, that is a bearish trend. Okay, so here, this is the 13 EMA we are talking about, and it is below the 50 EMA. The 50 EMA is down. Okay, they crossed there. So that cross there signified that this price is going where? Down. And you have seen how price nicely went up, making higher highs, higher lows, all those things. Okay. Then it started reversing here. These lines, they crossed again here. The 13 EMA moved up, showing that this market has changed direction. Now it is an uptrend now. Okay, so this is very easy and simple to identify. Okay, again, the same chart that I showed you. If you look at here, where I've boxed here, the 13 and the 50 EMA, they are crossing each other constantly, and the 50 EMA is flat. You can literally draw it like this. It is flat. So meaning here price is just ranging. So if you are a day trader, that point there is no trading there. There is no trading there. Okay. Then the 13 EMA went up like that. Okay, signifying that this price now is going in an uptrend. So you'll be catching opportunities all the way from the down there going up there. You're catching opportunities of buying the market. You're catching opportunities of buying the market. Okay, so with what I've said, I want to now move on to the chart.